We just had a crazy week of earnings with some of the biggest companies in the world, many of which we all own in our portfolios like Visa, Google, Microsoft, Apple, Amazon, and many others. On top of that, some of these stocks just announced new dividend increases. So today I'm going to react to the biggest winners and losers of the week and summarize their earnings reports and latest quarter. Let's roll the intro and get ready for some stock analysis. My name is Zach, this is Dividend Data, and you should leave a like and subscribe to the channel if you enjoy the video. And before we start the video, I just wanted to announce that my new AI stock research tool is now available on dividenddata.com. So you can now ask Dividend Data and get insights from your own AI-powered investment research analyst. It can answer your questions, screen stocks, write reports, and even summarize the latest earnings calls and quarters for various companies, which is a tool I will be showing throughout the video today. And this really does save you time when researching stocks, so I can't wait for you guys to try it out. And to celebrate the launch of this new tool, I am doing a 50% off sale for dividenddata.com because I want as many people to try this as possible. That applies to both the monthly and annual plan. The discount is locked in for life, and there is a 30-day money-back guarantee. Use the promo code AI at checkout if you sign up via the web app. Just select your plan and enter the 2 letters AI in the checkout field where it says add promotion code. Or you can click the link in the description and pinned comment to sign up via our newsletter and get the sale instantly, no promo code needed. And again, I can't wait for you guys to try this out and ask Dividend Data some questions. So first I'll do Alphabet or Google, ticker symbol GOOGL. We all know this company. It's one of the largest big tech companies in the world. They reported Tuesday after market close and beat on both revenue and earnings per share. Their earnings per share came in at $2.12, which was a 14.59% increase over analyst estimates. And this was definitely in the winner category with the stock shooting up after the news. And I'll get into the earnings report. It was very good across multiple fronts. However, later in the week, they did retract many of those gains. And I actually used this as a buying opportunity to start a position for Google in my dividend growth stock portfolio, which I will talk about in my portfolio update video in the coming days. So stay tuned for that. So this quarter was very good for Alphabet, and really most of Google's quarters have been good since fall 2022. For revenue, Alphabet reported a 15% increase year over year, reaching $88.3 billion for the quarter. And Google's largest business segment, Google Services, grew revenue 13% year over year to $76.5 billion. And that was led by Google Search and YouTube ads, with revenue up 12% year over year. And subscription and devices revenue saw a 28% increase. Google Cloud revenue increased 35% year over year to $11.4 billion. And by the way, when we're analyzing Alphabet's business, it's very important to put everything in the context of its different business segments. Google Search is still the cash cow for the company. That represents $49.3 billion of revenue by itself. And then in my opinion, the other 2 most important business segments are YouTube and YouTube ads, which has now grown to $8.9 billion for the quarter. And keep in mind, there's also YouTube Premium and YouTube TV, which is additional subscription revenue, which I am assuming is put into this larger Google subscriptions, platforms, and devices bucket. And then the third and fastest growing business segment by revenue is Google Cloud, which has now increased to $11.3 billion. And here you can see that revenue for Google Cloud increased 35% year over year, thanks to their investment in AI infrastructure and generative AI solutions. Also, the operating margin for Google Cloud improved to 17% in the quarter. And you guys know from my other videos that I'm very bullish on cloud services over the next decade plus. I think that is a long-term growth sector, and that's a large reason why Microsoft is the #1 stock in my dividend growth stock portfolio. And we'll also get to Microsoft's quarter, by the way, later. So from a fundamental business perspective, when you're analyzing Google stock, you need to be thinking about how you think about Google Search, YouTube, and Google Cloud. Those are pretty much the core pillars of Google's business. When you throw those all together, that's over 75% of their total revenue. But on top of that, they also have their other bets category, which has a lot of actually really cool investments. One of which is Waymo, which is their autonomous taxi business. And that is in the market in San Francisco and Los Angeles, now expanding to, I believe, Austin, Texas very soon. And they're now doing over 150,000 paid rides per week. And over a multi-decade time horizon, I'm very bullish on self-driving vehicles and self-driving taxi networks. I think that's going to be a huge growth industry. However, in terms of business realities, I think that Tesla is much more poised to take advantage of that compared to Waymo. And I went over that a little bit in my Tesla stock review video I put out a few weeks ago. But Waymo is definitely becoming more and more valuable every single year for Google. Other things I like about Google as an investment is since fall 2022, they have been more focused on cutting costs. I also fundamentally like that they're one of the leaders in AI. And in this quarter, they reported that 15% of the new code they write and put into production came from their artificial intelligence. So not only does AI create opportunities for making new products that weren't possible before and improving their recommendation algorithms across search, YouTube, etc., but they can use it internally to improve the operations of their own business. And I think that's an underrated aspect of these large technology companies, is that they have the internal talent to be able to implement all these AI solutions first. And if you go and listen to interviews with the NVIDIA CEO, you will see him talk about this, how they have all these leading internal AI tools for how they run the company, making them more efficient and more productive. And I did see an interview recently with Sergey, one of the Google founders, who came back, and he's now working and focused internally on helping AI at Google. So I do think that is definitely a core focus for them. And now let's take a quick look at Google as an investment. You can see with the latest quarter of earnings per share of $2.12, that continues their long track record of high earnings per share growth. And really, this is quite impressive for the company. And despite all-time highs in earnings per share, they are not at their all-time high in stock price, which happened back in July at $191. In fact, the valuation for Google is quite compelling at a 22 P ratio. And analysts are projecting continued double-digit growth rates in earnings per share all the way through 2028. And if they hit these metrics, then the 2028 P ratio based on the current stock price is 12.2. Which is very promising. Google is not anywhere near done growing by the time 2028 comes around. And Google is now a dividend payer with a quarterly frequency, giving it an 80-cent per share annual dividend. At the current stock price, that's a 0.47% dividend yield. Their business is incredibly dominant and they have a fantastic balance sheet. The only concern I really have in terms of their financials is the very large amount of stock-based compensation. But I understand strategically they do that in order to retain talent. Other concerns are rising capital expenditures, which is from all their increased data center spend to support AI infrastructure. So strategically, this is very important. And this is something that's happening at both Google and Microsoft, is increased capital expenditures. Luckily, they have such a high cash flow and margin business that their free cash flow is still very strong. But this CapEx increase is putting short-term pressure on Google and Microsoft. But the accelerated growth rates in terms of revenue for all their business segments is more than offsetting that at this time. Also on Tuesday after the bell, they had Visa, ticker symbol V. Visa beat their earnings report on both revenue and earnings per share with a 5% beat in earnings per share, bringing in EPS of $2.71. So let's look at some other highlights for Visa. Revenue was up 12% year over year. EPS was up 16% year over year. They had 8% growth in constant dollar payments volume, 13% growth in cross-border volume excluding Europe, and 10% growth in processed transactions. So overall growth was solid double digits, which is in line with historical expectations. And the most important part here is fiscal 2025 outlook. They said that adjusted net revenue growth is expected to be in high single to low double digits. And they restated their goal to continue returning capital to shareholders via dividends and share buybacks. And that's exactly what they're doing. In Q4, they repurchased $5.8 billion of shares, and they bought back $16.7 billion for the full year. And they just announced another 13% increase to their quarterly dividend payment, bringing it to 59 cents per share. And one thing to note here, I guess, is that Visa's dividend growth is slowing down, with this most recent 13% increase being lower than the prior 15.5% increase and much lower than the 2022 2022 increase of 20%. But overall, this is in line with the 5-year compound annual growth rate of the dividend around 14.48%. The Visa dividend payment remains incredibly sustainable at a 22% free cash flow based payout ratio and 21% earnings per share payout ratio. It should also be noted that this new dividend raise brings the current dividend yield to 0.81%, which is in the historically high range for the company. In fact, the current dividend yield of the Visa dividend at any time is never over 1% due to the low payout ratio and the relatively premium valuation that the company trades at, and that's due to its extremely dominant business. Over the long term, I do think Visa stock will continue being a dividend growth machine and a very good stock in terms of total return in your portfolio. After reporting earnings, Visa stock is up 3% on the week, and I would put them in the winner category along with Google. Next up, I'm going to bring up Microsoft, ticker symbol MSFT, which is the other top stock in my dividend growth stock portfolio. They beat on both revenue and earnings per share with a 1.67% beat on revenue and a 6.45% beat on earnings per share. That gave them EPS of $3.30 for the quarter. After reporting earnings, the stock fell nearly 7%, and overall they're down 5% on the week. So you might be saying, Zach, I thought Microsoft had a good quarter. Well, in terms of stock price, they're in the loser category. But let's dive a little deeper into how the actual business performed in that quarter. Overall, revenue was up 16% year over year, operating income was up 14% year over year, and earnings per share was up 10% year over year. And the most important segment for Microsoft is Intelligent Cloud. Their overall cloud revenue grew 22% to $38.9 billion. And Microsoft Azure, which is their main growth business for cloud, increased 33% year over year in constant currency. And specifically, their AI-related cloud business is on track to surpass $10 billion in annual revenue. So things are looking very good for Microsoft there. Also, their productivity and business services, which includes Microsoft 365, their revenue grew 12% year over year. And this is including the rollout of Microsoft 365 Copilot, which is their AI Copilot tool. And I do think over the long term, that will continue to increase revenue growth for Microsoft 365. So Microsoft's business is doing fantastic, and they have a big growth opportunity in front of them with AI. And I've done full stock reviews on Microsoft in the past, but when you think about AI with them, it accelerates all of their existing growth businesses they had. They already had the growth business of cloud. They already had the growth business of subscription business software. And you could go on and on down their different businesses. Growth in AI is kind of a double-edged sword in that it requires a lot of capital investment right now. And this is a delicate balance the company is trying to make because you strategically have to invest in it. And it makes complete sense, but at the same time, you want to manage cost. And when we take a look at Microsoft stock, you can see this explosion in quarterly capital expenditures, hitting $14.92 billion in the latest quarter. And that's a $5 billion increase year over year. But you can see this increased CapEx is now hitting their short-term growth in free cash flow. Free cash flow is actually down slightly year over year. Overall, though, I think all the fundamentals at Microsoft are still in place for the long term, and it's poised for double-digit growth in revenue, earnings per share, and over the long-term free cash flow. They may overspend on AI-related CapEx in the next year or two, but over the long term, I'm pretty positive that will be the right move. And if you don't own Microsoft stock and we're looking at it, I would have used this sell-off as a potential buying opportunity. I personally did not add to my stake as I already have Microsoft as my number one stock in my dividend portfolio, representing around 25% of that account. But if Microsoft stock continued falling into the high 300s or $360, $370 range, I would start adding more at that time. But Microsoft is one of those stocks where it's a core pillar of my portfolio over the long run. And there are possible catalysts over the next year where Microsoft stock could fall from an earnings report again. And that would be their compression in their gross margin, which is now down to 70%, which is still fantastic, and their increase in capital expenditures. But again, these are the good kind of capital expenditures where you're funding a growth business for the future. The next stock I'm going to bring up is my third largest dividend growth stock in my portfolio, the Altria Group, ticker symbol MO. Now, this is a very different kind of company from Microsoft, Google, and Visa. This is a high yield company with massive free cash flow, but in a slow growth kind of declining business segment. So with a company like the Altria Group, I would be upset if they had massive growth in CapEx, but we'll get more into that later. So Altria reported their Q3 earnings and they were up on both revenue and earnings per share with a 3.94% beat on revenue and a 2.2% beat on EPS giving an EPS of $1.38 per share. And the Altria Group was definitely in the winner category from this earnings report. They're up over 8% on the week. And Altria had a very good quarter given their expectations. Their smokable products segment grew operating income up 7.1% year over year. And that is despite the volume of cigarettes they sell declining every single year. What they do is they raise prices to offset that decline. And actually, usually they raise them to try and get continued EPS growth. And I'm sure last year was a relatively weak quarter for them on a relative basis, but this is a positive sign that they're seeing growth year over year there. And their oral tobacco segment grew 2% year over year. So as long as you're solid in those categories, that's the main thing for them. They have continued progress in their two growth businesses, which is their new vape product, Enjoy, that has continued rolling out well. Their other big growth business is On nicotine pouches. This is basically the leading competitor to Zyn in the United States. And right now, these are small product segments, but over the long term, they will become bigger and bigger parts of the company. Another big thing that happened in this quarter is they gave guidance for their full year 2024 EPS, giving a range of $5.07 to $5.15, which is an increase 2.5 to 4% year over year. And for a company like Altria, this is solid. They trade at an extremely low valuation with a 9P ratio even after this recent increase. The current dividend yield is 7.57%, and I was buying this stock when it was trading at a 10% dividend yield. So I actually don't think I would buy the stock at current prices, but I do think they'll have continued slow growth from this range as long as they maintain growing their business. And as long as they can grow low single digits year after year, Altria stock will have really good returns, especially from the price that I bought. Their dividend payment will continue to grow, and I'll reinvest those dividends to acquire more shares, and my dividend snowball effect will really just be rolling for this one. So I feel good about the Altria Group, and I would put it in the winner category. So next I'm going to talk about Intel, ticker symbol INTC. They beat on revenue by 2%, but missed on earnings per share by a large amount, with EPS coming in at negative 46 cents per share. And despite that, the stock actually boomed after earnings, going up 12.87%. However, they fell throughout the week leading up to earnings, so they actually were only up 2.3% on the day. So in terms of that stock price increase, you might say Intel was a winner, but there was a lot of very bad news for Intel in this report. On the surface level, they just lost their spot in the Dow Jones Industrial Average to NVIDIA, and I don't think Intel will be making it back in anytime soon. You can see Intel's revenue just continually declining over the past few years. It seems like they took some impairment charges in the quarter, which is why they had such a bad quarter in terms of profitability. GAAP EPS was negative $3.88, and non-GAAP EPS was negative 46 cents. So in terms of like real money in, money out, it was not as bad as it looks on paper there, but still Intel is not doing well. Oh, so here's some more context on that. They had $15.9 billion in impairment charges and $2.8 billion in restructuring cost. What I like to do is I like to look towards free cash flow with these type of things. And free cash flow for the quarter was negative $2.7 billion. And that's due to their massive capital expenditures. They had $6.76 billion in capital expenditures. So you have like companies like Microsoft and Google spending more money on CapEx, but that's specifically related to AI CapEx, and that is a growth business for them and fueling the revenue growth at their company. So Microsoft and Google are still growing businesses at this moment. Intel's business has declined significantly over the past few years. At the same time, they are spending massive amounts of money on new chip fabrication plants with unknown business economics in the future. It is not known yet whether Intel will become a successful third-party chip manufacturer, which is what they're going to have to do. They are betting on basically becoming the next TSMC. In the meantime, you have all of Intel's core business segments basically declining, and they're getting their butt kicked across the board. CPUs is not a growth business at the moment, and I don't know if it will ever be a long-term growth business again. Don't get me wrong, CPUs will still be around, and even on that front, they're getting competition from AMD. And then their data center business is getting shellacked because basically all new data center spend is going towards AI infrastructure. And Intel's data center business was not oriented towards AI really at all until recently. And that started by them changing the name of their data center business to Data Center and AI Revenue. And I'll give you a hint, AI is not a big part of that revenue right now. And don't get me wrong, over the long term, that will happen. Intel has very smart people working there, and they're transitioning the business. So basically, you have the low growth CPU business, which is facing competition from AMD. And then you have the high growth potential data center and AI related business but they're getting shellacked by NVIDIA because all that new spend is going towards NVIDIA. And at this point, Intel really doesn't have the ability to compete with them in that dimension. So even though Intel may have been a short-term winner based on their earnings report, I would stay away from Intel stock for a number of years. And if you're buying it, this is something where you just don't even want to look necessarily for like 5 years or so and just wait for the turnaround to happen. But there are likely far better places to invest your money. All right, next we have ExxonMobil, ticker symbol XOM. This is another top stock in my dividend growth stock portfolio. They missed on revenue by negative 4.18%, and they beat on earnings per share by 2.13%. So what's going on with ExxonMobil? So as we know, most of the oil and gas business, their profitability depends a lot on the price of oil at any time. And over the past year, the price of oil is down, and we were in a relatively low patch in the last quarter. And this is reflected in ExxonMobil's earnings. They are not anywhere near those 2022 highs in earnings per share, which is completely reasonable, and people weren't expecting them to at that time. They were over earning in that time. And now they've returned to lower, but still highly profitable levels. And right now, ExxonMobil is increasing their production. They also just finished their acquisition of Pioneer, which will give them even more production capacity and room to find synergies between their business and lower their cost. And over the past 5 years, they've lowered their production cost a good amount so that they can be more profitable at lower oil and gas prices. And nothing's really changed here with my opinion on ExxonMobil. I bought it at a great price during 2020, and I am just riding the wave over the long term with this one. I'm collecting my 10% plus dividend yield on cost. And despite how cyclical their earnings can be in this kind of business, Exxon is a consistent dividend growth stock throughout all these periods because they manage their balance sheet so that they can survive any economic environment. And this is highlighted by them just announcing another 4% increase in their quarterly dividend payment. And they've now increased their annual dividend payment for 42 years in a row. And that's a claim less than 4% of S&P 500 companies can make. They also lead their industry in total shareholder returns over the past 3, 5, and 10 years. So I feel very good about having Exxon as a core part of my dividend portfolio, given my very low cost basis, but I'm not really interested in buying more at current prices. And initially after reporting earnings, Exxon was up around 2.8%, but then they lost all of those gains throughout the day, and they ended up the week being down negative 1.58%. So Exxon, I wouldn't necessarily call a loser, and I wouldn't call them a winner either. It was kind of just a quarter for them. They kind of just met expectations. And finally, I'll share T. Rowe Price, ticker symbol TROW. This has been a high yielding stock in my portfolio, but with low growth lately, but long term has seen high dividend growth. They missed on revenue by 2.4%, and earnings per share beat by 10.3% with EPS of $2.57 in the quarter. So with T. Rowe Price, revenue for the quarter came in up 6.8% year over year, and revenue for the trailing 12 months is up 8.9% year over year. And growth in earnings per share has increased even more with a 38.81% increase year over year in quarterly earnings per share. And over the trailing 12 months, EPS has grown by 30.03%. And the reason for that is that they came from this very low base after 2021. They had a huge drop off during that time, and they've slowly been marching that way back up as the market has improved. And with a company like T. Rowe Price, they primarily make their money through fees on assets under management. So that's a key metric for them. In the quarter, they closed with $1.63 trillion in assets under management, which is up 3.9% from the last quarter. However, they still had $12.2 billion of net outflows. So they're still having trouble getting new inflows and new investors into T. Rowe Price. And a large reason why that is because their business is so mutual fund heavy. That is the core part of their business. And mutual funds really are making less and less sense for the vast majority of investment cases. ETFs and passively managed funds really have taken a large chunk out of the market there. And that's why T. Rowe Price is moving into the ETF space. And they've been expanding their ETF business over the past few years, which has helped them stop this outflow problem. And ETFs are now a growth business for the company, although these have lower fees than their traditional mutual fund business. But for me, the most important part I was looking at here is that T. Rowe Price expects further increases in net outflows during Q4. Although excluding a one-time termination of a sub-advised variable annuity, excluding that, net outflows are estimated to be less than half of 2023 levels. And in the future, the company is expecting to reduce net outflows in 2025, although they're not expecting to have positive inflows during 2025. But that's still progress, and this stock probably isn't going to surge until they start getting positive inflows. But part of the thing I like about T. Rowe Price's business at like a fundamental level is that that doesn't have to happen in order for them to make really good money, because it's all about assets under management. And if they invest intelligently, they can grow that AUM, and as long as that grows, their fees will grow as well. So yes, they had net outflows, but their assets under management were up 3.9%, and that helped improve their economics in the quarter. And there is something kind of elegant about how high margin and simple this business model is. And basically, as long as they can convince people to give them money and they're able to grow that money, then T. Rowe Price has potential to just rake in cash. And over the long term, I suspect that they'll do quite well. I also do think T. Rowe Price is pretty undervalued with the current price below the lowest price target on Wall Street, and it's currently trading 24% below the consensus price target of $139 per share. So I think I'll continue having a position in T. Rowe Price stock, but there actually was some changes to T. Rowe Price in my portfolio and some other stocks in my portfolio, along with new buys. So stay tuned for my new portfolio update video so you can see all of the changes I made and why. So I hope you enjoyed this video, and I would suggest trying out my new AI tool available on dividenddata.com. I used it throughout the video, and if you've ever used ChatGPT and those kind of things, I really would recommend trying this out. This is specifically designed to help analyze financials and stock analysis, and it has much more reliable real-time data, the actual earnings transcripts and quarterly reports that it can pull from. And this is a major upgrade to dividenddata.com, so I really want as many people to try it out as possible. So we're doing a 50% off sale. You can use the promo code AI at checkout, use the link in the description and pinned comment, and you can lock in that 50% discount for life. So I really would recommend you redeem that while it's available. There's a 30-day money-back guarantee, so no risk in trying out. And if you enjoyed the video, leave a like and subscribe to the channel, and see you very soon for my portfolio update video. Thanks for watching.